And we're live, Howard.
Hey, Ivan. We are going to get right to a special edition. I call this kind of a quarterly 8 to 80 update. These are stocks that, for me, that I kind of come up with my own system of companies that I believe 8-year-olds and 80-year-olds love. And these are the companies that can stick in your portfolio for a very long time. And companies really that you focus on adding when they're down 20, 25%. You don't so much have to chase them or own them every minute, but at some point over the next 2-3 years, you will get opportunities to own them. I think there's 14 or 15 stocks right now. I dropped Starbucks. So let's go through some of them and give everybody an update.
All right, let's share my screen real quick. And are you able to see it, Howard?
And we're going to start with Visa.
Visa and MasterCard.
Visa and MasterCard are both on my 8 to 80 list. Why? Ubiquitous brands, especially in North America, where kind of my focus is. You know, most great companies, you don't have to go chasing overseas. They just reside right here in the good old US of A, although they may hide their taxes elsewhere. These companies have been in my the 8 to 80 portfolio forever. You know, 8-year-old kids that have their first debit card to 90-year-old people that are living day to day. Know the brand, use the products. MasterCard and Visa have very simple business models, and despite crypto chatter for the last 2-3 years, they're doing quite fine. That said, no company is ever guaranteed remaining in 8 to 80, and as I make room for new companies, I may drop one of them. But you can see relative strength remains strong, above 90. We're using the MarketSmith chart, so thanks to the people at Investors Business Daily and MarketSmith. But you can see these companies just daily. Go to the monthly, Ivan, on MasterCard. You know, you hope for dips. You want massive dips to these. Now, of course, every major dip feels like a horrible time to buy great companies. But unfortunately, you know, that's the way markets work. So Visa and MasterCard are on my 8 to 80 list.
Okay, so let's continue with the Chinese one, the Alibaba and Tencent.
I believe both are in my 8 to 80 list. Are they, Ivan?
Yes, they are.
So I look at both of these companies and I'm, depending on who I ask, you know, who's going to be the biggest company in the world, and probably over the next 10 years it'll be, you know, between Amazon and Alibaba. Although I think Tencent has a great chance. Alibaba's just a diversified, basically massive financial and e-commerce site out of China.
Do you remember your conversation with the Ren founder when you asked him that same question? Would you bet on Amazon or Alibaba as being the, you know?
And he thought Amazon, but he thinks Alibaba will beat Apple. You know, he believes Apple has brand risk with the tariffs, et cetera. I'm not going to get into all that quite yet, but I mean, listen, when the Chinese are bullish on the company, when wealthy Chinese people are still bullish on this company, I'm still bullish. I feel this is an 8 to 80 brand. Do you buy it? Again, you want to buy these stocks when they get beat up. These are not cheap companies, but this is a brand in terms of Ant Financial in China, and obviously the Alibaba e-commerce site that are just, you know, if you're going to own China, this is the way to own China. Tencent is probably my favorite company. It's a brand that not too many people know. It's just been a relentless uptrend. You know, here again, and like 45.40 may be an opportunity to add. I'm not adding up here, but these are stocks that I've owned in my 8 to 80 portfolio. WeChat, probably other than Facebook and Instagram, one of the most recognized brands globally in terms of a communication product. Strong relative strength, correcting with the market, but definitely part of my 8 to 80.
Yeah, definitely both Chinese stocks that we just mentioned, you know, I mean, their charts need some time to heal. Definitely.
8 to 80 means that these are brands that are going nowhere. Do you chase them all the time? No. I generally prefer to add 8 to 80 positions when the companies that are on those lists are hurt. Let's pull up Nike, for example. Nike to me I was really loving it at 50. You know, do I love it at 67? I love it, but I'm not adding more here. And we can argue there's hundreds of 8 to 80 brands, and there's no perfect system. I'm trying to have a well-rounded group of companies for any beginner investor that wants to understand the companies that they own and give them a list, a starting point. And the list has done very well over the years. So Nike is one of those companies. They're more leisure. It's not going to increase 1,000% from here. But again, I believe in fashology, and Nike's, fashion meets technology, and Nike is, to me, other than Adidas, which, I don't own, Nike's is the leader there.
Nike's chart looks amazing, by the way. Look at that weekly chart. It's
the market hasn't. I think if Nike can get some action, like I said, I believe that the transition to the new CEO, who's a great CEO, the pass off, most of these 8 to 80 companies, as you'll see too, one of my things is they're run by the original founder. Now, obviously with Phil Knight, he's much older. I think his book last summer was kind of like the Bible and the handoff. So
yeah,
that the next generation of employees will be able to read that book and go, don't fucking screw up the brand. So again, I think Nike is positioned here globally.
I mean, definitely the sports shoe market.
I'm just super bullish. Again, the stock, I'm just super bullish on the brand and the company.
Grows up about 10%.
These brands you want to buy when they, a lot of these companies you want to buy when they're down 20%, as I was, in the 50s. Am I rushing out to buy these at their highs? No. But that's why we have different strategies for different markets. Okay, elsewhere on the list is Google.
Yeah, just one second.
Is the perfect forward-looking tech ETF. People say they want to own tech ETFs, and I'm like, well, keep it simple, own Google. You have exposure to AI, robots, you have exposure to search, you have exposure to advertising, you have exposure to global. You also are not going to have the unmitigated growth that they've had over the last 10 years. But at the same time, it's an 8 to 80 brand. At 800, I'd be adding it. At 1,000, for people that want to own their first stock and are thinking about buying an ETF, I think Google is going to do just as good for you as an ETF in the text.
It's a gigantic company that continues to grow earnings and sales at more than 20%.
By the founders, highly motivated. Again, meets a lot of my criteria. Next.
Okay, let's go to Disney real quick. It's also on your list.
New one that I'm not proud of this yet. I felt like the company was going to break out. It's been in a sideward market, and I could be wrong here short term. I replaced Starbucks with this. So, it is an 8 to 80 brand in the sense that everybody knows the brand. Where it has struggled is in the digital world. And I believe they're about to solve that in the next 12 months. And markets are forward looking. I've just been wrong about when the market will price that in. So either Disney really is missing here, relative strength is 26. It has just been a dog.
Look at their earnings and sales growth at the bottom left. I mean, they've been struggling the past few quarters. But
again, replace Starbucks with Disney. I am definitely, this is one that I'm going to give a short leash. But in an era of Netflix and streaming, they are the most undervalued company. Meaning, once Disney moves digital, I could expect their stock to be able to switch paths. And so timing that is very hard. I don't think you have to rush out to buy Disney today, but I'm long. Okay, and it is a new addition to the 8 to 80.
Yeah, if we assume, and it's true, of course, that both Netflix and Disney are great original show creators, and the future of the world is virtual reality, then both of them are supposed to do really good.
I just think we live in an era of free time, in an era of robots, and so Netflix, which is we're seeing right here, has been the winner of the 8 to 80, is the true winner of 8 to 80 in the sense that you've got cord cutting, you've got subscription business, you have a global business, you have everything that could go right for a company is going right, and including we have the founder who's survived many changes. I don't know how you don't own this stock in your 8 to 80 portfolio. And so the winners of the 15 stocks that I have in my 8 to 80 portfolio, you recognize all the brands. But what's amazing about the winner is it makes up for the Disneys of the world. Meaning I'm trying to have them all look like Netflix, but they don't necessarily always turn out like Netflix.
Howard, do you know that Netflix currently has more international subscribers than US? Only
I don't go that deep into the numbers, because if I went that deep into the numbers, I'd have to come up with a real justification of why valuation I own the stock, and nobody does. I just believe that 20-30% dips are when people in the 8 to 80 list should get interested, as long as the fundamentals of the core business have not changed. And so we should hope for 30% pullbacks. Now, if you're long the stock, you don't like me saying that, but that's how markets work. Okay, next.
Okay, let's go to Apple then.
Okay, there's no stock hated more that's made more money for people than Apple. I don't get it. I'm sure it's not going to have its best years ahead of them. Obviously, it's not run by its founder anymore. I don't know. There's no products I use more. I don't buy into the negativity on Apple. I do believe law of large numbers is at work. But again, I think I say Apple Music and subscriptions, and then AI and which they're behind on but can play catch up, and then augmented reality, meaning they could buy Snapchat tomorrow for a nickel of their own, relatively, and be a leader in AR. So there's many ways that Apple can buy their way out of trouble. They don't have a history of doing that, but they could be forced to do that. And at the same time, I look at Apple Music and I look at the AirPods, and I look at leisure in America and productivity, and I just say Apple's a leader. I don't know how you cannot have it in an 8 to 80 portfolio. Okay,
let's go to Amazon then.
I think Amazon and Netflix make up for any mistakes that anybody's ever made in investing. So luckily, that's been part of the 8 to 80 portfolio forever. There's not much to say. It's perfection.
All right. So we have a few.
Could stop Amazon, but again, entry points are few and far between. So
my theory is real quick that I think Apple will be the first $1 trillion company, but Amazon will be the first $2 trillion company.
Yeah, and I don't even want to get into. They're just 8 to 80 companies, and if they go to if Amazon drops to 1,000. That's an entry point. At 1,400, congrats if you've owned it, and just keep an eye on the list. Next,
let's go to Microsoft then.
Is that on my list?
It is, yeah. It's on your 8 to 80 list.
It's mainly on my list because of, and I worry about this with Fortnite because of their acquisitions have been great, and anybody was a better CEO at the time than what they had. Probably the closest company because of overlap and having too much exposure to tech. So it's a company that I'm thinking of dropping because I don't use the products personally. So I'm a little biased there. But an 8 to 80 brand because of Xbox, because of Azure, because of their Office. And
their enterprise software product is doing really well. I have a friend whose company is just to sell, Microsoft Azure, and he said that after super weak last year, this year everything is through the roof. Like everyone is. Because
corporate, again, it's an enterprise company, and stocks are being valued because of this tax break at the enterprise level. But probably the most I'm not tied to in my 8 to 80 list.
Mm-hmm. So we have
exposure to tech.
We have 4 more. Facebook.
Yeah. I put it as a buy at like the 150 to subscribers. There's a perfect opportunity to add to something down 20% that's on the list. It's not a stock, not a company that, I use WhatsApp and Instagram. So it's not so much about Facebook as it is about just, owning just the most information, the best information, best sentiment data in the world. Pretty much hard to stop them. And now it's all out in the open. They're going to be regulated. They can afford to be regulated. Again, you don't chase these companies, but 150 turned out to be a really nice point. There's so many people that need to own these stocks over the next 30 years. And it's a great 8 to 80 brand. Love them or hate them.
Okay, so let's go to the next one. FedEx.
Yeah, it's just a pure e-commerce, great 8 to 80 brand globally. You think of shipping and you think of people showing up to your house next to Amazon, it's FedEx.
Are you really concerned that Amazon will build their own service?
Yeah. Yeah, and again, I'm not tied to any of these. It's been a winner for us, but probably be one that will at some point drop out of the 8 to 80 portfolio.
We have a couple more. This one is a little bit more J&J, Johnson & Johnson.
Yes.
More conservative one, yeah.
A great 8 to 80 brand over the years. If you look at the monthly,
let's go to monthly.
It's basically Walgreens with better margins. I mean, they make pretty much every product you use in your bathroom. I think as the world changes a little bit, as the CPG model changes, again, this is why you own Amazon and micro brands. I mean, Johnson & Johnson just won't have the growth. But again, it's on my list because, down 20%, this has been historically a great company to own. Most people use from their shampoos to their soaps to their Band-Aids to their medicines. It's a really easy company to understand.
And we have the last one. It's Match.com.
Yeah, the reason I love Match, it was a newer edition, was that, and you can see the relative strength at 99, and I think at around $16, $17, I got excited about and added it to the list last year. Dating is global. It's a social network. They have a great business model. It's not just a free app. And, it's worked. I think Match.com is not just Tinder. It's hundreds of brands rolled up. They pretty much from 8 to 80 own the dating and matchmaking. So it's a massively globally diversified dating business with an incredible business model.
So it has outperformed.
At $30 when everybody's panicking it just doesn't seem like a buy up here. But again, I'm glad that it was part of our portfolio. But again, these are the ones when you see blood in the streets, these are brands that you can come back to. You haven't had an opportunity to buy this, in size since it was the high teens. We'll find other 8 to 80 brands over the months that replace some of our new brands. One that I'm looking at right now is Lulu.
All right, let's take a quick look.
I dropped Starbucks, and I'm looking at Lulu as a potential 8 to 80 brand. My daughter owns some. I spent a lot of money there. The prices are always going to be high, but they have cut out a market that, in North America at least, there's not anybody athletic who doesn't know the brand, and their margins are better. And they figured out e-commerce and retail. It's a tough business. That's why I haven't added a pure kind of retail company. But as I look for a brand that could be around for 20, 30 years and expand into Asia and has great margins and great products, Lulu is that type of 8 to 80 brand.
Okay, so do you want to finish with that, or?
We'll finish with that. I'm glad we ran through them, and quarterly we will
update.
We'll update it. And thanks, Marcus Smith, for the charts. Okay, Ivan.
Okay, thank you, Howard.